Hello, and welcome to the End of the Chain. I'm your host, Samuel McCulloch, and I want to welcome you to this episode. In this episode, I have Kain from Synthetix, who's coming on to chat about synthetic assets. This is actually pretty cool because we talked about the differences between what's being built at Synthetix versus what's going on at Maker, and also what do you actually use Synthetix for. So it was a really good chat. I had glad to have Kain on. If you like the End of the Chain, make sure to subscribe, leave some 5 stars wherever you listen to. And also, we're going to be doing a Gitcoin grant coming up again, so make sure to tune in and donate. It's always helpful. All right, that's going to wrap it up for today. Let's hop into the episode. We're joined by Kain from Synthetix, and I have been enamored by the idea of Synthetix on Ethereum, right? Because one of the big things that I harp on is that ETH and Bitcoin are like terrible for payments, right? And so the idea is of these crypto assets to be used as payments was quickly lost back in 2000 and whatever, a couple of years ago, right? The only thing people use them for is speculative asset or speculative trading, and then also for growth of storage value, I guess if you want to say. And so Maker was the first to come along and really solve the idea of what do we do? What do we use all of this like wealth for? What do we use all this value for? We turn it into dollars, and then people can use those dollars to go off and do fun stuff like I don't know, make payments or invest in them or build all these cool composable DeFi apps that we have right now. So Synthetix has really, I guess, you guys had was it a rebranding or a pivot last year into offering all sorts of different types of synthetic assets. And now it seems that there's really a ton of possibilities that's happening in 2020 and beyond. So welcome to podcast, Kain. It's
thanks.
I'm glad to have you on. And I guess I would want to get your idea on, and so your ideas and thoughts on like what all of these synthetic assets mean, and really like where and what they're going to be used for. Like, why do we need them?
Yeah, I mean, ultimately, I think the end goal is to give people the ability to have exposure to different asset classes while remaining on Ethereum. So there's a whole bunch of cool properties that you have when you've got an asset on Ethereum. So you kind of touched on it, composability. You can kind of safely store it and transfer it, and if you can create a system that will allow a range of different assets, so commodities and different crypto assets and potentially equities and indices and things like that. You can create some really cool applications that you can take advantage of having this price exposure on Ethereum. You can kind of combine the power of Ethereum and this permissionless platform with price exposure to every single asset. And so that's the idea of Synthetix, to essentially give you price exposure or enable people to build applications that give people price exposure to essentially any asset for which we have a price feed in the real world.
Right, but the difference is that when you have something like a commodity-backed gold token, right, like DigiX Gold or Tether Gold or something, that is, I know Tether Gold is redeemable. You can take that and go redeem it for like an ounce or 10 ounces or whatever the limit is. You can like go and get physical properties, there's a physical delivery of that gold from those tokens. So if the future, right, if we assume in the future that all the commodities will have like one-to-one tokens that exist on Ethereum, right? So you can have a physically delivered gold token or an oil token or anything else. What would be the benefits of working with a synthetic token?
I mean, I think it comes down to sort of cost and infrastructure, right? So realistically, does anyone really want to be able to redeem these tokens for a gram of gold, right? There's someone in our community, GMGH, who kind of makes fun of some of these asset-backed tokens, because this redeemability is supposedly such a valuable property, when the reality is people just want the price exposure, right? There 99% of people are never going to convert their gold tokens into an actual gram of gold and go and put it in their safe deposit box or whatever. So I mean, the same thing really applies to something like a synthetic equity as well, right? The fact that you can have price exposure to a synthetic equity without having someone to hold the underlying asset, and have custody over it, is quite powerful. And there's, I think, another property which is permissionlessness as well, right? So this idea that if there's a custodian that is holding the underlying asset from which the asset derives its value, with this token derives its value, if that custodian falls over, loses the assets, or stops redeeming, or does any kind of problematic thing, the asset immediately loses its value. And so the advantage you have with Synthetix is that it is a purely synthetic asset. There is no one holding or custodying the underlying assets that Synthetix tracks. You're just getting price exposure to it. And the way that we provide price exposure is through these crypto economic incentives that we built, that are designed to enable you to have that without needing to put gold in a vault somewhere, or hold share certificates or whatever.
Well, I mean, but you've had that, so I don't know. I mean, you have CFDs down in Australia, right?
Sure. Yeah, absolutely.
Okay, so I mean, it's similar to the creation of a permissionless CFD then.
Yeah, exactly. You just get the price exposure. There's no custodian. No one's holding the underlying asset. No one needs to go. In theory, no one needs to go to the spot market. I mean, ideally, what you want is people to be hedging, because of the way the mechanism works, where you've got these pooled counterparties who are providing the price exposure. Ideally, those counterparties that are in this debt pool should be hedging their exposure in the spot markets, but you don't need to rely on that. If they don't do a good job with that, that's not going to impact your ability to convert the asset into some other asset.
But it's not like you'd want to build a long-term portfolio, because I don't really know anybody who would want to build a portfolio inside a CFD platform. Either the fees are going to get you, or especially when it comes to maybe for, like commodities like gold and oil, where there's no dividend payouts. But as soon as you get into equities, it's just better to hold the equity itself. So.
I mean, I guess it depends on the type of equity, right? Like if you're buying, Tesla or Apple or something like that, right? You probably aren't participating in governance. It's unlikely to be dividends. You're probably just kind of happy to have the price exposure. So it does kind of depend on different classes of equities, I suppose, as well.
Right, but I'm guessing when you guys do move into equities, or something like an equity, like a S&P index future, or not an index future, but an index synthetic, is going to be one of the first that gets put up, right?
Yeah,
like a
yeah, exactly. Yep.
But the S&P index pays out dividends. It's actually one of the main ways of making money by buying the S&P, is through the dividend payout.
Yeah, and so you need to work out how you manage dividend payments, and
can that be done with the Synthetix?
I mean, it can, it can in theory be done. You need to essentially create some kind of mechanism where you match the dividend payment with some kind of like in-kind payment. Maybe it's more exposure to the asset or something like that. So it more accurately tracks it. But to be honest, we haven't kind of finalized the spec on what we're planning to do with equities. Most likely, we'll launch with equities that are unlikely to issue dividends as a kind of starting point, as a trial.
Yeah, no, I mean, that would make sense, just so you don't have to deal with
the complexity of that. And I mean, there's trade-offs, obviously.
Yeah, exactly. I mean, the math that would go into trying to rebalance the token price post dividend would be, I think, pretty difficult. Yeah, but again, like, so, like, when it comes to actually like building with these things, I mean, how do you think do you think it's going to remain like a niche product within the crypto space, or do you think that it has the potential to I don't know, like, get to, I don't know, 10 billion, $100 billion in the size of the market that it could provide?
It kind of depends, I guess, on the trajectory of Ethereum as a platform. I think, right? If Apple had built the App Store and the iPhone had become kind of like a niche product, and there are a few million of them floating around, but it wasn't really used by that many people. Um, it's hard to see any particular app in the App Store getting to critical mass, right? There's just not enough of an install base to kind of do that. So I think we are somewhat reliant on the efforts of Ethereum, the community, the platform, et cetera, to kind of
Mm-hmm.
grow. And I mean, we're seeing that happen. Samsung installing an Ethereum wallet into phones, right? At some point, you hope that Apple puts some kind of crypto wallet or a crypto vault into an iPhone at some point down the road, right? And that will just massively expand the addressable market for dApps and crypto applications. So I think it's not going to be Synthetix driving that necessarily.
Yeah,
I don't think we're going to necessarily be the killer app. But what we do
I think it's Maker. It's the killer app.
yeah, for sure. But again, you still kind of need that install base for the network effects to kind of kick in and make it powerful. At the moment, it's still very crypto, DeFi bubble kind of phenomenon, I guess, right? And
Yeah,
so I think that I think there's an opportunity for all of the different protocols to kind of grow alongside this overall growth in Ethereum. But I don't know if we've necessarily seen the kind of killer app that's going to drive mass adoption just yet. Um, but it's probably necessary. And I mean, I think one of the interesting things is we're seeing a whole bunch of wallets come out, and different people build different wallets. One of the nice things about those wallets on Ethereum is they can consume and even combine and compose all of these different protocols, right? So they can give you a DAI savings rate account essentially, right, where you put fund it with a credit card, and then gets converted into DAI and gets deposited in the DSR
mm-hmm.
contract, and you're generating 8% yield or whatever. Then you could allocate 10% of that savings account to synthetic Apple shares, for example, right? You pick a portfolio of of high growth shares or something like that you think makes sense, or an index or an ETF or something like that. So the wallets that are kind of going out and onboarding people are going to have access to this kind of cornucopia of different financial products that they can mix and match and put together to create something valuable for their end users.
Yeah. I mean, so it goes down the path of what? Well, I'm not a Bitcoin maximalist. I'm a liquidity maximalist, and one of the things that uh, I find about Bitcoin is that it's always had this. The area that it's kind of lives in is an area of regulatory arbitrage. Like, there would be no need for Bitcoin if if money was, I guess, more free, and we had greater ability for private companies to mint different kinds of money, which we have now, right? It just took a long time, and just you're seeing that with Bitcoin and Ethereum and all the other different types of protocols that are trying to mint different kinds of money and see which one sticks in the market. I mean, the maximalists will tell you that Bitcoin's the only one that's ever going to stick, but what do they know, right? So Ethereum is making a big push right now, and the thing that Ethereum was able to solve was, again, it solved the volatility problem. And I was just chatting about this today with one of my colleagues, that the Bitcoin people are always, they talk about this like bubble theory of money, right, where the price just is going to be extremely volatile until it gets to a point where it's just not. Yeah. at some point, Bitcoin will become,
Also, Santa Claus is real, right? Like,
yeah,
any other myths that we want to propagate here, I guess.
exactly. And so this myth of declining volatility, which is not,
Mm,
is has been somehow been used to argue that Bitcoin can take over as global currency, right? And I don't believe that, because everything that we've seen, right? And maybe I'm just a like Keynesian pawn or whatever the Maximus want to call it, but everything that we've seen from monetary policy over the last 80 years is that the more stable a currency is, the better it is for growth in a country, right? As soon as it becomes unstable and volatile, it just wreaks havoc on the economy because nobody can plan anymore. So one thing that Ethereum solved, and it's by being able to create dollars out of Ethereum, out of a highly volatile asset, and to create something stable people can use. So this seems to be Synthetix seems to be like the next evolution of that, where you're moving just beyond a stable dollar value, and you're moving into the creation of other types of assets, right? So you solve the dollar, and now you move on to gold, silver, different equities and things, and the complexity increases as you go along, right? Like we were talking about with the like equities
yeah,
and dividends earlier. But the benefits of creating those assets allows you to build, or at least get price movements of those assets inside that area of regulatory arbitrage that Bitcoin and Ethereum kind of existed. And
yeah.
I'm not even sure what that means at this point, and what that actually entails for people and how they will use it, and companies how they use it in the future. But it seems interesting nonetheless. It seems it's exciting, right? Because you're finally unlocking the 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 true abilities. So you're just piggybacking on the properties of Bitcoin and Ethereum, or whatever kind of cryptocurrency you're using, right? You're taking their underlying properties, and then you're building it into like existing commodity or equity or any type of asset that we have now today. Um, so I don't know. I mean, I'm very excited to see how this works out over the next I guess decade, really.
Yeah, I agree. I think it's going to be really interesting.
Yeah. So, like, what have been some of like the coolest things that you've seen people like build with Synthetix so far?
Um, we're seeing some interesting compositions, I guess, in terms of providing liquidity. So we have one of the largest. We incentivize a pool in Uniswap, which is one of the largest pools in Uniswap. It's something like 25% of the total liquidity in Uniswap is in our SE pool, and that's designed to be an on ramp into the Synthetix ecosystem, right? So you need to take ETH or other assets that are on Ethereum and convert them into synthetic assets, so you can take advantage of the properties of being able to kind of reprice debt and take advantage of the kind of infinite liquidity properties you have within Synthetix. And so some people have built some really cool things that allow you to kind of take some ETH, convert that ETH into synthetic ETH, and then deposit that synthetic ETH into Uniswap to be able to stake the and get these incentives. And it can all be done in kind of one click, right? So there's like these mobile interfaces where you just take some ETH and you press a button, and magically these like 10 things happen in the background, which is really cool. And then I think what we're starting to see is some of the wallets are starting to look at implementing these different kind of strategies. Dex Wallet's a good example where you can kind of combine these different assets to create these like DeFi baskets, for example, right? So you might have some like synthetic Bitcoin, and then some um, regular ETH, and then regular rep, for example, right? And you get this basket of like these three different assets that
Mm.
that people might want to track. And I think as we get to your point around, okay, let's do dollars first, then let's do crypto assets and commodities, and get this proliferation, and you take that to its kind of endpoint. You get things like UMA, where you can create these very exotic assets, which might not have that much liquidity, but it kind of removes the constraints that you have on the synthetic system, where these pooled counterparties are taking the risk. So you can get things like their shitcoin index, right, which is this thing that tracks like the amount of shit that's found in San Francisco, which is kind of this cool idea of like being able to bet on how good is the government going to be at kind of controlling this issue that they have in the city at the moment. So I think you get this kind of this proliferation of assets, which can all be kind of combined together and access permissionlessly via these wallets, and create these really interesting financial applications out of it. And we're just starting to see like the very, very leading edge of that now, I think. But it's super exciting, obviously.
Yeah, I'm just amazed every day. I mean, one thing that I love about the Ethereum community is just the creative minds that come up with these like insane things that I see every single day. For people coming up with new projects, and especially when it comes to the ability to come like the compostability of it all, and to just like take dye, turn it into our dye, and then make our trees within a couple of weeks, just at a hackathon.
Yeah, exactly.
It's so cool, and it's one of the things that I think is going to be the lasting power of ETH, right? It's just the ability that developers have been able to have to try new things, and to be in an environment where those new projects can, I guess, flourish in their early stages until there's significant demand for it. Just like with yours as well too. I mean, you guys had what, like a year and a half?
Yeah.
Since after the ICO to kind of try different things and find a market fit before it really started taking off last year.
Yeah, it's taken a couple. It's taken a couple years. We're several years in now, and it does take a bit of time to kind of find, where the market is actually wanting you to go. You need to kind of keep your eyes open and be willing to kind of move with the market, because obviously crypto changes very rapidly. So,
I mean, how did you guys handle those pivots? Was it just looking for, I mean, user growth or token growth? I mean, what was like the metric for pivoting?
I think what we saw is that the sort of overall market structure changed, right? We had this idea of building a permissionless stablecoin with a different model to DAI, as an alternative to Tether. And then I think what we saw was this, kind of emergence of these different regulated asset-backed stablecoins like Paxos and, TrueUSD, Gemini, etc. And that's just kind of, marginalized, I guess, the alternative approaches, right? Because it's far easier to bootstrap, a dollar-backed stablecoin than it is a permissionless one, and we kind of looked at that and said, if we don't pivot here, it's going to be hard for us to get significant traction or adoption.
Yeah, because I mean, you look at something like USDC, which I think Coinbase has just done an amazing job with. It works so easily into their flow, and by them offering a like fee-free one-to-one switch to be able to come on to Ethereum is incredible. I mean, that's the perfect fiat on ramp.
Yeah, I agree.
Exactly. Yeah, and then all of that money can just flow, wherever it wants to, and it just, I think it really greases the wheel when it comes to providing liquidity into the system, because you need that sort of ability for institutional or even retail just to be able to come quickly, move their cash, turn it into digital dollars, and then take off and go buy Ethereum and do whatever they need to with it. And
yeah, I mean, I guess the only kind of issue, right, is it's one of these kind of tail risks that's there that we're kind of live with, and we all hopefully know about and kind of ignore and hope that it doesn't become a problem, is all of these regulated stable coins have kill switches, right? They can blacklist accounts and stuff. So you are kind of inviting someone into your house that could wreck the place potentially, which is, I think, a risk that we all need to be sort of cognizant of.
I don't think so though, because like even if they kill it, you can still get your money back. They
Well, no,
have
you can't. You can't if they blacklist an account because they blacklist redemptions, right? So, if someone feels that USDC, for example, in a specific wallet has been misused, they can blacklist that account and prevent redemptions or even transfers.
sure, but most people are law-abiding citizens, right, and have done nothing wrong.
Yeah, but I mean that's the argument for, oh, why do I need privacy? I've got nothing to hide, right? Like it's the
No,
same
I'm
thing.
look,
Like just in
I think there's
principle, in principle, if you introduce backdoors and kill switches into systems, you need to be aware of what the trade-offs are there. So it's
sure,
not
sure,
like USDC, and I like USDC, and I'm much more open to it than I used to be. I used to be much more ideologically opposed, but I do think that you can't treat it the same way that you treat Dai. Like it's a different beast.
no, of course not, of course not. Like Dai embodies everything that is Ethereum. It is Ethereum at its core when you talk about how it's secured and its permissionless nature and everything else. But what I was getting at was more about the ability to have these regulated stablecoins to provide amazing on ramps into the crypto ecosystem.
And
Where
I'm not disagreeing with you. Like I think that's a great thing. It's
Mhm.
just it comes with a trade-off, right? Like that ability to
Right,
on-ramp people really quickly comes with a trade-off, which is that they are regulated, they are permissioned. You know, it could go wrong. It hasn't gone wrong yet, and we're all happy and we're all friends and everything's
yeah,
flowers and lollipops. But it's very possible that something goes wrong. I mean, look at the BZX hack, for example, right?
right,
They used SUSD. What would have happened if they'd used USDC in that hack, for example, right? And tried to potentially leverage that. Does that wallet in the BZX vault get flagged and blacklisted somehow, and the USDC can't be withdrawn, or if they borrowed a bunch of USDC out of Compound or something like that? Like we haven't yet seen an instance where that's been used. Those backdoors have been used, but at some point they will be, and I think it's going to be a bit of a wake up call for a lot of people that are kind of blithely accepting that this is a benevolent sort of thing that we're using, right? Like the trade-offs are there, and they're kind of hidden away from us a little bit.
isn't Circles owned by Goldman, isn't it?
Yeah, yeah. So it's a consortium with Coinbase and Circle, and I think there's a couple of other small players that. But I mean, even Paxos, right? Like it doesn't have to. I'm not singling out USDC, right? Like Paxos says the
Yeah,
same thing. Gemini has the same thing. All of these regulated stablecoins have to have backdoors. That's part of the trade-off of being a regulated stablecoin that has deposits in banks, right? They've all got different
right.
kind of systems for blocking transfers, etc.
Well, I was just getting to the point that a lot of these more popular ones, or at least the ones that have popped up that have, like Paxos or Gemini or any of the other ones, they've got really big backers. They've got people who've got political connections now, like not just money that comes out of crypto, but like deep rooted political connections. The Circle's owned by Goldman, right? And Goldman has extremely close connections to half of, more than half, pretty much all of Washington, right? So any sort of regulatory action on like the U.S. part or from any kind of regulators or the law in general would be bogged down by the people who own it, and I guess create the regulatory space for them to operate in. That's why I don't really worry about them too much. Um, I think there's more issues when you get into well, just take a step back, right? So when talking about Synthetix, the collateral that's backing you guys right now is the Synthetix token, and then also Ethereum as well too.
Yeah.
Yeah. So what is planned in the future? What are you guys? I know you're probably looking at integrating more cryptocurrencies in, but will there be? Are you going to follow suit on what Maker is going to do in integrating real world assets into Synthetix as collateral?
I certainly hope not. I really hope not,
Yeah.
because you introduce this same issue, right? If you introduce permissioned assets, into a permissionless system, there's this fruit from the poison tree sort of effect, right? Where any asset, unless it's somehow siloed away, that's permissioned, creates systemic risk that kind of flows through the rest of the system, particularly with Synthetix. And so ideally no, but I'm not a dictator, and it's possible that the community could decide that they want to move in a similar direction if it looks like Maker's getting a lot of traction from adding permissioned assets and tokenized securities and things like that. Then maybe that's a path that the project goes down. But personally, like ideologically, I would hope that we don't do that.
Well, because Maker, I think Maker always wanted to have just these physical, like real assets inside their portfolio from the beginning.
I think Rune always wanted to have that. I don't know if everyone in Maker necessarily, in the community necessarily always wanted to have that. But I mean, there's an element of founder drives a project to an extent, right? So I think he has a pretty strong belief from what I've kind of heard, and from kind of hearing him speak, that in order to scale something to the level that they want DAI to be scaled to, you need to bring in these off-chain assets, which I think it's a theory. That's an assumption that they're building into their approach, and I don't know that we can say whether it's wrong or right or whatever, but our view is very much we want to stay permissionless, as permissionless as possible.
I see both arguments. I've looked heavily into both, and I understand the economic benefits of pursuing each, right? When it comes to what you guys are doing, I think it's really important to be able to leverage the abilities of the underlying protocol and to create synthetic assets out of that. So when DAI starts to integrate the real world assets into its system, yes, it will increase liquidity, but you're right, it adds systemic risk to it, which at this point no one's ever seen before, and I don't think the market really understands how to price it in. I mean, they may think they know how to, but I think it'll be too difficult in the beginning before there's actually some event which gives them better clarity on what to do. Now, when it comes to Synthetix, though, you guys have crystal clear idea of what the risks of operating on top of Ethereum are, and what some of the problems that could occur. But there could be less, or at least different in nature to what the Maker guys are going to do. So again, I think it will come down to really just what the market wants and what people actually want to use, right? Because maybe people want to have a purely permissionless synthetic asset generated through your protocol, which they can use for either portfolio building or payments or something else. And so again, it will come down to market considerations and what people want to use at the end of the day, like ideologically, right? Which I think drives a lot of the crypto ecosystem.
Makes sense.
Right. Yeah. I mean, it's something that will definitely be fleshed out over the next few years, I guess, and it'll be interesting.
Yeah, I mean, that's where I think it's interesting to see, people like Amin, right, agitating for permissionless ETH-backed stablecoins as well, right? This this meta project. So, I think there's definitely going to be some more experimentation before we have a sense of it. One of the challenges, though, right, is like once you start down this path and you start incorporating permissioned assets, it's hard to wind that back. It's hard to kind of split that out and kind of cauterize it from the rest of the system. So you almost need to just kind of make an assumption and leap and hope that you're right. And I think that's the way that Maker's gone about it. And on one hand, I kind of do hope that they're right and that works and doesn't have significant trade-offs that create issues. But I'm concerned. There's no question. I think there's a lot of people in Ethereum that are concerned that we lose this permissionless stablecoin when we add permissioned assets, and that might be a loss that is hard to kind of recover from.
Yeah. So you mentioned the BZX exploit that happened a couple of days back.
Yeah.
I've seen a lot of headlines since then, or at least podcast titles and YouTube titles of people saying, DeFi is just a house of cards waiting to fall, or some other kind of shocking headline to grab attention. Is there any? I know there's some truth to that. There's always exploits and vulnerabilities that can be found, but does the compostability just create additional risk for every single new app that builds on top of each other, or people taking? I know that people are taking Synthetix and leveraging it up 6 times, and then somebody's taking that and putting it into a token set, and also there's going to be a bunch of crazy compostability ideas, which will that can be done by throwing a bunch of stuff together and seeing what sticks. Is it really is there large systemic risk that is built from having a system like that of what's being built in DeFi right now, or is it manageable and it can be worked through I guess community development and auditing?
Look, I mean, people trying to steal other people's money is not a new problem, right?
Yeah.
This is a thing that has kind of plagued every system in existence, right? That's ever been built to handle, financial transactions. The big difference, and I think the thing that sort of changes the threat model for DeFi, that maybe we probably haven't given as much. Consideration to and haven't been as concerned by as we should have, and these flash loans and things like that have kind of you know illustrated the risk. But the big difference is that I did a podcast with someone 3 weeks ago who's used to work in the FX industry, right? There's plenty of people that would try and scalp them on trades and extract money or whatever. Like if there's an exploit that's available, people will do it, right? The big difference is that those people are KYC'd, you know who they are, they have an account, you can turn up their office, and if they're really defrauding you, right? It's one thing if they're taking advantage of mispricing, but if they're genuinely defrauding you, there's a legal system that you can fall back to say, like, go and arrest those guys, right? We just don't have that same mechanism in DeFi. There's no go and arrest the pseudonymous wallet, right, that did this thing, and particularly I think as things like Tornado Cash and privacy solutions like Aztec become much more used, this only gets worse, right? Because once someone steals ETH, that ETH is gone, right? There's no way, to recover it, and so you have these huge, honeypots, right, of value in lending protocols and Synthetix and Maker and all these different places where there's tens of thousands of ETH just sitting there. Uniswap has hundreds of thousands of ETH, right, sitting there waiting for someone to work out a way to extract it, and you have zero recourse. There's nothing you can do to get it back, right? If the person does a good enough job in kind of obfuscating their identity, such that you can't tie it back to a real world person, and even if you could, what jurisdiction? Like, there's jurisdictional issues. Like, this is a really, really hard problem, and so you basically are saying, if you fail at all, right? Like, if you're not 100% infallible, you are going to have people steal money from you, right? Whereas with a centralized service like an FX broker, the risk, the kind of, the calculus for an attacker is slightly different, right? Like, okay, maybe they try and set up a fake account or a fake name or whatever, but, the recourse is much, much higher. And so, you really don't have the same level of just, open warfare almost that we have with DeFi, right? And I think the danger is on top of that as people are successful, it kind of emboldens other people to try, right? Like, someone sits there and goes, well, hang on a second, someone just stole 6,000 ETH, right? Like, I want to have 6,000 ETH. I'm a smart guy, I can go and find a bug. And then you have hundreds of people or thousands of people or whatever, combing over these different protocols trying to extract value out of them, and very little recourse. So it's it's not to say that it's a house of cards. I just think it's a much, much harder problem than standing up a centralized, service with a database and, KYCing everyone and having, recourse to a legal system. The the uh, the sort of attack surface and risk profile is just totally different with those two systems, and we need to be aware of it. I think, as people building those platforms, and I think we need to be aware of it as consumers of those platforms as well, that, we're in somewhat uncharted territory here, that, if something goes wrong, there's no kind of, way to wind things back. So it's not to say that it's a house of cards necessarily, or, everything is has been done poorly or whatever. But I just think the kind of the challenge is much, much greater than, building other financial services that are kind of centralized.
Yeah. I mean, do you guys have protocols if there's a critical bug in Synthetix that's found and someone's able to drain some of the collateral pools?
I mean, the interesting thing with Synthetix, interesting slash terrifying, I suppose, is, all of the markets, if you will, are, every asset is connected to every other asset, right? So the only thing that's kind of preventing someone from draining the entire liquidity, is off-ramp liquidity, right? So, if someone were to attack the system, the first place that they would probably go, if they're able to, work out some way to exploit it and either generate a ton of assets or generate a ton of value that's incorrect, is to go to Uniswap, right, and drain that Uniswap pool. And there's, circa 30,000 ETH sitting in that pool, right? So, that's a big, big honeypot. And it's been sitting there for 8 months and no one's drained it yet. So there's a level of, just like Uniswap, the longer you have, hundreds of thousands of dollars of ETH kind of sitting there as this open bug bounty for anyone to find, the safer you probably, the safer it is. But there's plenty of examples of, people finding a bug, a year later. I mean, look at Heartbleed, right? Like 10 years later, that's
Yeah.
just been sitting there in plain sight. No one noticed it. And then all of a sudden someone's like, wait a second, let me look at that again.
It's the Thanksgiving turkey fallacy.
Totally.
That Nicholas Talon talks about.
Yeah.
Where turkey thinks he's just fine. It's getting fat, it's getting happy, then all of a sudden he gets his head cut off.
Exactly. So, so we can sit there and say, okay, great. We survived for, 2 years. It means we're probably more robust than something that's survived for, 2 weeks, but it doesn't mean that, we're invincible. Right. And so, I think that, that it just requires, and it's hard. Like, I'm not going to lie. It's a very, very hard thing to do. It takes a certain kind of mindset, and I think everyone can be better at it. You're having this very sort of paranoid mindset, and these incidents have a way of kind of crystallizing thought a little bit, right? And really forcing you to be laser focused on, are we comfortable with doing everything we can to protect these funds and protect our users and protect the platform. And the answer is never going to be yes, right? You're never going to have done everything you could reasonably do, because there's always trade-offs in everything. We also need to kind of build the platform and get momentum and all that sort of stuff. But it definitely puts you in a situation where you start questioning assumptions and previous threat models that you've kind of been working under, when all of a sudden anyone can spin up a 50,000 ETH flash loan to go and attack you. That changes the calculus a little bit, I think. So, we're constantly reviewing the system and constantly thinking about how we can make it more robust and safe. And it's just an ongoing mindset that you kind of need to live with, I suppose.
Yeah. What do you think about the flash loans? I mean, think they're here to stay, or would you like to see them phased out by some of the projects that have created it?
I mean, look, anything that can happen in Ethereum will happen, right? Like, there's no way to phase something out. Once something exists, it's just going to exist, right? So you have to live with it. I made a joke on Twitter the other day about like, giving out free bazookas, right, to like see which houses were or buildings were like well built, right? And it's like, on some level, like that's kind of what you're talking about, right? Like these people are like, yes, flash loans are going to weed out the weak or whatever, right, and crush these protocols. And I guess on some level, like that is actually right. We'd rather do it now and kind of flush out the things that aren't robust or haven't been built as securely as they should have been. And flash loans will definitely make it obvious which protocols have got weak points, right? Because one of the interesting things I suppose with flash loans is the threat model that I think a lot of us were operating under maybe in 2017 or 2018 was, okay, fine, so someone's going to have 30,000 ETH, right? How do they get that 30,000 ETH into a wallet that isn't tied to an exchange or isn't tied to their identity somehow or can't be traced to a Genesis wallet or something? Do you know what I mean? Like, how do you actually get a pool of ETH that's that large that can't be tied to anything else, right? And the answer was like, you almost can't, right? It's really hard to do that. Maybe some ICO funds or random things that have popped up, but it's pretty hard to get a pool of ETH that's that large, 10, 20, 30,000 ETH. Now anyone can spool up an anonymous pool of 30,000 ETH or 10,000 ETH or 20,000 ETH, right? Like it's kind of a different reality, right? So where you might have said, well, if someone could get 30,000 ETH and have it be totally anonymous and not be worried about it being tied to their identity, could they do X? And if the answer was, yeah, I guess they could, but that's not really likely to happen. Now the answer is that is definitely going to happen, and you need to close whatever those loops are, or close whatever those potential exploits are. In our case, the answer is no. We don't have anything that we're aware of right now that is exploitable via flash loans, but it doesn't mean that no one does. So I think ultimately, it's a good thing, but it's a very, very brutal way of kind of weeding out poor security practices, right? We can probably do some things that are less impactful on users and the community to kind of instill better thinking and better tooling to kind of reason about these things than just walking around with the bazooka blowing shit up and seeing who survives.
Yeah. Now, what about so? Just to come back to the collateralization part, I know there's a lot of projects that are trying to bring inter blockchain, interchain liquidity. So essentially, the first goal is really to bring Bitcoin to Ethereum, and that's being done with TBTC, and then also Ren Project is working on that as well too. Is that a potential future collateral for Synthetix? Is also to have,
absolutely, 100%.
Okay.
Yeah, I mean, we've talked about this idea of becoming a decentralized BitMEX, right? This permissionless system that allows you to do leverage trading, etc. And the reality is, as good as Ether is as a collateral for trading, which is why we've added it, to the platform to allow people to borrow against their ETH and trade. There's just a lot more Bitcoin out there, and there's a lot more people used to trading with Bitcoin, used to using it as collateral, on BitMEX and other platforms. So it would be foolish for us to not, do that. That said, we need to choose an implementation of a Bitcoin bridge that is permissionless, right? Because as I kind of alluded to earlier, if you introduce a permission system like wrapped BTC, it just creates systemic risk in the system, and regulatory capture, and other attack vectors become, much more concerning. You take it from 0% likelihood to, some unknown likelihood, which is obviously a phase change. So.
Right. But then you're relying on the bridge then to maintain the bridge, right?
Agreed, but I suppose my argument would be I'd rather have like a crypto economically incentivized bridge than let's put some Bitcoin into BitGo, a custodian, and hope that they give it back to us. Do you know what I mean? Like
Yeah.
they're a very different approach to the problem. Which isn't to say that wrap BTC is a bad idea. I think it's a good idea, and I think it has uses, but it's not something that we would want to add as collateral within Synthetix, because it just changes the overall shape of the system.
I think the red team was also.
They are, yeah.
Yeah, they were in charge of wrap BTC. So I mean, for them, the REM project was kind of like the next step for them to take wrap BTC and turn it fully trustless.
Yeah, exactly.
Bridge that they have.
Yeah. So I think people are working on it. I think it's something that'll happen. It's one of those one of those things that once it's ready, we'll be ready to incorporate it for sure.
Yeah, but is it? I mean, would it be only Bitcoin and other proof of work coins? I mean, what about some of the like EOS and other delegated proof of work?
Probably not, to be honest, right?
Yeah.
We probably wouldn't incorporate other crypto assets as collateral. I think Bitcoin, just because of its kind of historical use as collateral in trading platforms, is a lot of people that just get it, right? I don't think there's that many places where EOS is being used as collateral for trading, maybe on some EOS casino or something like that, but yeah, not in the wider community. So I don't think it would have that much attraction, to be totally honest.
Mm-hmm. Yeah. Okay. Interesting. Like, because I'm like most looking forward to seeing how that happens. To see kind of the liquidity. Like, one of the chats I was having with like previous guests was that because all the DeFi is congregating on Ethereum, is that all the liquidity will be sucked away from, or at least ported over into Ethereum. And I don't know if it just brings the value back into the protocol itself and the token price goes up, or if just everything kind of like naturally exists on its own. People move between one thing and another. But I'm sure it'll increase the liquidity. I'm sure that it will drive trading on platforms where people can earn better yields than just letting their tokens sit. So I don't know.
It's interesting, right? Like, we've got a model for this. It's not like there's no precedent anymore, right? Like, there's an absolutely enormous precedent that if you are a Bitcoin maximalist should scare the shit out of you, which is look at Tether on Omni transitioning to ERC20, right? Like, it's just an obvious thing that's going to happen, and anyone who's paying attention to the kind of launch of the ERC20 Tether token could just see the writing on the wall, right? Like, there's zero chance you're going to sit there and wait for an hour for block confirmations and what have you, like moving in and out, when you can wait 3 or 4 minutes, right? And so that transition of Tether away from Omni and onto Ethereum doesn't bode well for Bitcoin, in terms of where most of the Bitcoin value is transacted. And I'm a big Bitcoin fan. I love Bitcoin, but I don't see how transferring a permissionless tokenized version of Bitcoin on Ethereum is not going to be a significantly better user experience. And I don't see how the average person who's holding BTC and wants to move it between exchanges or do whatever they're doing or trade it on dexes or whatever is not going to move their behavior and switch their behavior to using a tokenized version of Bitcoin. Provided there's and look, maybe not even provided there's a permissionless version, right? Like, wrap BTC is in this weird kind of uncanny valley of like permissioned, and so therefore there hasn't been a lot of demand for it. I feel like if there was a permissionless version of BTC, that transition could accelerate. But a lot of the Bitcoin in the world is dumped on exchanges or in BitMEX or whatever. You know what I mean? So it's not like people aren't willing to put their Bitcoin into the custodian's hands, right? So there's a lot of people who use Bitcoin all the time for trading or whatever that don't care about custody at all. It's not their number one priority. So if Bitcoin integrated into Ethereum, was faster, better, cheaper, whatever, it's hard to see how that doesn't start to shift and get a meaningful transition across. Which again, you've probably got a bunch of Bitcoin maximalists screaming at their screens right now, but yeah, that's just a reality. I don't see how it doesn't play out that way.
Well, here's the thing that I look at, right, is that if you own Bitcoin and you want to access, like, let's say there's DeFi Bitcoin, which is coming through RSK, you have to go access RSK as a layer 2 protocol. There's like extra steps that you have to take, and it's not native to Bitcoin itself. If you want to use Bitcoin as a payment system, you have to go you have to figure out how to get bridged into the Lightning Network, and then you can use it, right? But all of these things can be done natively on Ethereum. I can use DAI as dollars easily for payment, right? I can use Ethereum to collateralize the Synthetix contract, all with a couple of clicks, and I don't have to rely on any layer 2 solutions to be able to do that.
Yeah, true.
Yeah. So I think that the coming like something I said earlier is that there's, because of the amount of developers, the amazing developers that are working on Ethereum right now, just the creative spirit that goes into designing things like Synthetix and all of the other like amazing apps and amazing dApps, or whatever you want to call them, on Ethereum at the moment, the ones that will be designed in the future, I think it draws liquidity away, or at least it ports liquidity over, and I don't know if it detracts from Bitcoin's long-term value proposition, but it opens up things that they don't have right now, or may never have on their layer 1 or layer 2 networks. And
yeah,
maybe
agreed.
that,
Agreed.
yeah, maybe that, I still, deep down in my heart of hearts, I still believe that some sort of flipping will happen. So maybe DeFi is the thing that unlocks the ability for Ethereum to really make some value gains over the next decade.
Yeah, agreed.
Because the Bitcoin maximalist argument is just, there's only 21 million Bitcoin. It's only going to be able to, people can only own so much, right? That's the only thing they can ever say about why the price and why the price of Bitcoin go up. It's just, there's only so much, right? But with ETH, they're going to have similar supply schedules now. But in addition to that, you have all the things that people are building onto it, whether it's the NFTs or synthetic assets in your case, or all the DeFi stuff that's getting built, and just the amazing amount of work that's going into building out the ecosystem. I don't know. Sure. It really seems like it could have more long-term value than whatever's being built on Bitcoin.
Yeah, agreed.
Yeah, but don't tell your maximalists that. But then again, I guess I've always been skeptical of Bitcoin. I don't know when did you first find Bitcoin yourself?
I was running an e-commerce business from like in early 2010s or whatever. So I came across Bitcoin through Slashdot, and was into payments, right, and have been into the idea of micropayments and different payment services since like the late 90s or whatever. So but to be totally honest, I didn't quite get the value prop back then, even. But we set up a Coinbase account in 2012 and started advertising. We accepted Bitcoin on the website for people buying stuff. Although I don't think anyone ever did actually buy anything, unfortunately. But yeah, it was definitely a couple years before I really kind of got it. I think just kind of seeing it, thinking about it, or whatever. It took a while. It wasn't like a eureka moment for me when I first read about Bitcoin.
Sure. I feel the same way. I'm just still skeptical as well. One of the things that really cauterized a lot of my thoughts that I hold today is that in the boom of 2017, I was in a place where a lot of so there's these markets that exist in Russia, right, where it's a bunch of Chinese people who come over and bring their goods and they sell them on to the kind of outskirts of Russia, and then
Right.
they take rubles in, they take cash in all day, and then there's a couple of people who exchange those rubles into like digital assets. So during the boom times in 2017, when Bitcoin was just going up and up and up and up and up every single day, these people who were working in like selling the goods, collecting the rubles, and then trading them would want Bitcoin at the end of the day because they knew that even in the space of 24 hours, the price could go up 5%, 10%, and they could just send back the Bitcoin that they owed at the time, and then keep the extra, 5% or 10% as themselves, and pocket that or sell it off and keep the extra money. One second. Hello. Oh, hi.
Hey.
How's it going?
Hi. Yeah. Fine.
Sorry, the cleaners are coming in.
Yeah, all good. Just a heads up, I got to run in about 5. So.
Yeah, we can wrap it up.
Yeah, cool.
Yeah, I'll finish the story, and you can.
Yeah, cool.
But as soon as the price peaked in 2018, everybody switched to Tether, and nobody wanted to use Bitcoin anymore. Obviously, because the price would go down there on the opposite end. But even when things kind of mellowed out and it was sitting around 6,500 for a long time, nobody wanted to use Bitcoin anymore. Everybody had just moved back to the dollar, at least a digital dollar, to be able to move money across borders. So I don't know. I mean, since you've been in payments for a long time, did you see something like similar around that time, or have you come to like similar conclusions about that?
I mean, the whole kind of thesis of Haven, right, the original project was, to enable some of these kind of pockets of crypto consuming markets, right? Like Australia was a net importer of crypto, right? There isn't a big mining community here, right? So all the Bitcoin that people wanted to buy needed to be imported, which meant that money needed to be repatriated, and you had this similar issue of a spread that kind of increased over like throughout 2017, right? Similar to what happened, with the kimchi premium for the Korean market, and so we kind of had this idea that okay, if we can get in and create this permissionless stablecoin that people could use to arb this out, potentially that could kind of help to alleviate the issue. But as I said, the regulated stablecoins kind of came and blew that value prop out of the water, I think. So we had to kind of pivot and find something that was a little bit more crypto native, I suppose, which we eventually found with digitizing and tokenizing synthetic Bitcoin, etc. So yeah, it was kind of a roundabout way of landing, in a space where we wanted to still be able to kind of tap into the speculative aspect of price exposure, I suppose.
Right, but I mean, like as someone running a payments company, do you think that Bitcoin can succeed as a payments like at least a payments vehicle long term?
I mean, no, like I really don't, right? It kind of depends, right? Like, can it succeed in transferring value? Yes. Can it succeed in buying cups of coffee? No, I don't think so. Like, I just don't see how that's possible, right? People who are kind of presuming like hyper Bitcoinization and things like that, like they don't really seem to that too far off from like the XRP army, to be totally frank, right? Like, I don't think. I think they're kind of starting with priors that are very biased based on their financial alignment with the price of Bitcoin going up. So I think that I feel like no. The answer is no, but at the same time, then you see $100 million transaction, in the space of less than an hour, right, across the globe, anywhere, and you go, that's pretty impressive, right? So, value transfer is one thing, payments are another thing. So I think storing value and transferring value, I think Bitcoin has a lot of benefits. But for payments, it doesn't have many benefits. And I'm pretty skeptical of Lightning as well as a way of kind of alleviating some of those pain points. I just don't think it's that likely.
Yeah. I mean, well, that's probably a good place to wrap up on. I know we covered a lot in here. This is hopefully fun for you. I know you've been doing a lot of interviews.
Yeah, definitely. Yeah. It was good fun. So
where can people find you on Twitter, actually?
So you can find me. My handle is at KAIYNNE. That's where I say crazy shit on Twitter every once in a while. I don't obviously advocate for handing out rocket launchers to random people on the street, but yeah. So yeah, you can find me there. And then if you want to follow Synthetix, it's Synthetix_IO. Is like the official Twitter account. And I mean, the best place though, to be honest, is like jump into our Discord if you really want to kind of dig in and ask some questions. We've got an amazing community. There's some really dedicated people that are in there all the time answering questions and helping out. So yeah, that's the best place to kind of find out more about the project.
Awesome. Well, Kain, thanks for coming on the episode, and hopefully we'll have you on again in the future. Hey everybody, thanks for tuning in to another episode. I'm Samuel McCulloch, the host of The End of Chain, and everything on this podcast should not be taken as financial advice. You should seek help from any tax professional or investment advisor before making any investments into crypto. Also, I want to thank you guys for listening to this podcast. It's been really nice to build the audience that we have. We're growing, and I want to thank you guys. So I'm sorry about the audio today. I had the wrong mic source, but we'll be back for another episode in just a couple of days. Got a bunch of cool guests lined up. Thanks everybody, and I'll see you soon.